cap rate increase has nothing to do with demand of multifamily. It's 0% change in demand that I've seen, right? There's massive amounts of dry powder available. It just has to do with financing. If you cannot finance a purchase, you're not going to pay for it. You're going to pay less. And so as interest rates have gone up, the amount that investors are willing to pay has come down. And as that amount has declined, we've seen cap rates rise very smoothly across the United States for all kinds of assets, not just multifamily. So we've seen that cap decompression happen all across the board in commercial real estate.
All right, welcome to Real Estate Hustlers Podcast. I'm your host, Josh Appleman, founder and CEO of Appleman Properties. Today we have Neal Bawa, the acclaimed mad scientist of multifamily, commands a portfolio exceeding $1 billion. His data-centric approach and compelling speaking engagements set him apart from real estate landscape. Neal, we appreciate you coming on the show today. If you could let the listeners know a little bit more about yourself.
Sure. I'm a technologist, a computer science graduate, a data scientist by training, and I am interested in changing the real estate world through the use of data science. I have a lot of geeky and nerdy investors, especially in Silicon Valley, but all across the United States that follow what we do, about 25,000 of them. And 1,000 of them have invested in our projects. We've raised $300 million of their money to buy or build assets in 6 different asset classes. The net value of the portfolio at completion of construction is about $1 billion.
Nice, very cool. So you're with your data points, every way you aggregate data, and you see everything happening in the market, especially in the commercial real estate. What are you seeing with debt and equity, and how it's affecting the valuations and financing?
Well, I mean, the effect that we are seeing because of debt is very straightforward, and it's very predictable effect. As the Fed started raising interest rates, if you remember, the first increase was March 2022. Here we are, somewhere at the end of 2023. So 18, 19 months have passed. And if you look at the last 19 months, as those interest rates have increased, the Fed funds rate has increased, we have seen a corresponding increase in cap rates. And these rates, they've fluctuated by metros. Certain metros like Phoenix and in Austin might have seen larger increases. In other metros, especially Midwest metros, have seen smaller increases in cap rates. But all across the United States, there's been a 100+ basis point increase in cap rates. At this point, probably 125 basis points. Some markets are 150. And it's very predictable because that cap rate increase has nothing to do with demand of multifamily. It's 0% change in demand that I've seen, right? There's massive amounts of dry powder available. It just has to do with financing. If you cannot finance a purchase, you're not going to pay for it. You're going to pay less. And so as interest rates have gone up, the amount that investors are willing to pay has come down. And as that amount has declined, we've seen cap rates rise very smoothly across the United States for all kinds of assets, not just multifamily. So we've seen that cap decompression happen all across the board in commercial real estate, with multifamily being somewhere between 100 and 150 basis points, depending upon market.
So are you? How do you get them financed? Are you looking for a 10-year horizon? Because 10-year term, shorter. That way you can possibly refinance into different type of debt here on the so hopefully in the future. How would you suggest underwriting your deals to accommodate?
Well, there's 2 options for you. One is you look at the 5-year, Freddie Mac product. So Freddie Mac has a 5-year product which is tied to the 5-year Treasury. So if you look at the 5-year Treasury rates today, whatever that rate is, 4.6, whatever it might be, it's going to be some number above that. So let's call it 6.3, so 175 basis points above that. And so now you're basically getting a 5-year fixed rate or loan, and then you're selling your asset at the end of those 5 years. So you can't sell it really during those 5 years because there's prepayment penalties that are so large that most of your profit is going to disappear in the prepayment penalty. So now you're basically committing to own and run your property for 5 straight years. That's your option A, and that's what a lot of people are taking. And your option B is simply to assume an existing loan. There's a lot of properties out there that have assumable loans. So about half of the properties that we're looking to buy are in category A, the 5-year Freddie loans, and the other half are in the assumable category. We do expect that within 6 months, we will go back to bridge loans. So it will take about 6 to 7 months for us to go back to bridge loans. here we are, in November. I think that if I was doing a deal next year in June, July, August, September, it's likely that I'd have a bridge loan again.
So you feel the rates are going to be coming down favorably by next June or July?
So I track. There's data on the marketplace, and this data I'll just pull it up on my side so I can give it to you. And there's data that is change. It changes every day, and it is called the market's bet on Fed rate cuts next year. That's in 2024, and this is available from Bloomberg. So you can go to Bloomberg and type in market bets on Fed rate cuts next year. And you'll notice that they go out every single week to all of the big players in the market, the banks, the hedge funds, Goldman Sachs, people like that. And they say, what is your bet on how much lower rates will be in 2024? And I can tell you that the bets are increasing. So the market is more and more betting that the Fed will cut interest rates. For a while, actually, the market was betting that they would cut them less as we saw, the economy being stronger. But today, the market is betting, and this is this morning in the Bloomberg's article, a 93 or looks like a 92 or a 93 basis point cut next year. So for those of you that are not familiar with basis points, you should be if you're in multifamily, by the way, that a 93 basis points would take a loan that's 6.3% today down to 5.4% roughly, a year from now. And so what they're saying is by the end of next year, all the market participants, which are the dozens of banks and the big hedge funds, are saying that in 2024, rates will drop 90 basis points. Now, if you look at what the Fed is saying, the Fed itself has something known as the federal dot plot. Now, the Fed is known to be extremely, extremely conservative on the dot plot because they don't want the market to become bullish. Their goal is to slow down the economy. Their goal is to reduce inflation. And they can't really do that if they are bullish. So they tend to be extremely bearish. And they're basically talking about a 50 basis point reduction in the interest rate by the end of 2024. I think the market is more likely to be right because the Fed at this point has to be very careful not to, goose the markets, not to basically, have the markets become hot. They've managed to cool the S&P 500 down. So as you know, the S&P 500 has now gone into bear territory, and that was the goal of the Fed. And the Fed basically doesn't want to offer any kind of signals that would spike the S&P 500 again.
Yeah, it's you can definitely tell a huge shift in the stock market once they come and give out their guidance of what they're doing, just like we've seen last week. Given the current economic indicators, what are the key factors investors should monitor when considering multifamily investments here in our current situations?
Before we continue, let me take 60 seconds to tell you about Multifamily University. Are you ready to take your real estate investing to the next level? Look no further than Multifamily University. Our comprehensive resources, including guest podcast appearances, educational webinars, the Real Estate Trends Toolkit, and the Location Magic course, are all designed to make smart investing easy and accessible. Plus, with no subscriptions, no upsells, you can trust that we're always looking out for your best interests. But don't take our word for it. Check out what our satisfied customer, Carlos M., had to say. Neal's presentation was filled with invaluable information that is not readily available to the average investor. This group takes you to the elite level of investing. Join the ranks of the elite with Multifamily University. Join us at multifamilyu.com and start investing from a place of knowledge today. Not only will you have access to a wealth of knowledge from industry experts, but you'll also be able to stay ahead of the game with our in-depth analysis of market trends and potential recessions or corrections. Invest with confidence and make informed decisions based on data, not gut feel. Don't miss out. Visit us at multifamilyu.com today or click the link in the description below. And now, back to the content.
The first big factor that they need to monitor is inside of their brain. So look at the factor that is between your two ears, okay? And I want you to think about what I'm about to say if you're an investor or you're a general partner, okay? None of you had any issues buying sub 4 cap properties 22 months ago, 20 months ago. The peak of the lowest cap rates, which is the peak of prices, was March 2022. So we're 19 months into this rate hiking cycle, right? From the perspective of price declines. We didn't have any issues at that point of time accepting sub 4 cap pricing. You didn't have any issues with accepting increases in rents that were outrageous, 4%. I've even seen 5% in performas. And you, as investors, poured tens of billions of dollars into those properties. Today, those properties are 25% cheaper with the same income. The income hasn't changed. Same income. It hasn't gone up because rents haven't gone up. So same income, right? Nationwide, properties are 25% cheaper. And everyone who's projecting rent growth today says rent growth is in the 2% range. So today, you are having trouble investing in multifamilies that are 30% cheaper or 25% cheaper with much more conservative forward-looking growth projections. Are you really an investor? Or are you, like most other people, a speculator? When 18 to 24 months ago, you should have been terrified. Today, you should be excited and greedy. If that is not your mindset, then perhaps you are a speculator and you only invest in markets that are ultra hot. Well, in that case, you should wait for the next 3 to 4 years and not invest any of your money, because if a red hot market is what you wish, 2026 is the right time to invest. If you're a value investor like Warren Buffett, my idol, this Warren Buffett right now would be delighted to invest in a bunch of things that are getting cheap. Now, the stock market is not as cheap as the real estate market. We have not seen 25%, 30% declines in the stock market, perhaps 10%. So maybe he would still not be very excited. But in the multifamily industry, we've seen 25% reduction from peak. And so to me, I'm greedy right now. I believe in what Warren Buffett says: be greedy when others are fearful. Be fearful when others are greedy. If you were listening to me 24 months ago on these podcasts, maybe Josh's podcast, I was saying, I think prices are too high. I don't think that people should be buying. I think people are being overly aggressive. I think that this math doesn't make sense. Today, I'm saying the math makes sense, but nobody wants to buy because of fear.
Yeah, that's spot on. I was on a webinar last night, and the survive till 25 is out. It's make it until 2027, which that's exactly what you said. 2026 start getting in, and then you'll get a little bit ahead of the forward curve. But right now, we're seeing it's on sale. It's at discount, so it's kind of exactly what everyone's been waiting for. Um,
And the discounts don't last.
right.
Understand this. We have not seen any reduction in interest in multifamily. In fact, the interest has increased. The reason for that is very simple. The office sector, unlike multifamily has a 94% occupancy. The office sector is now in the low 80s, which means that the whole sector as a whole is becoming illiquid. Basically cannot refinance. And then there are many cities in the United States that are now dropping into the low 70s, which is basically just a debacle, like an absolute meltdown. And so there's people who have always invested in office that would not invest in multifamily, and these are very, very, very rich people and large funds that are now saying, we're going to switch and we're going to allocate 50% of our money to multifamily. So there's no reduction in multifamily demand, right? There's a reduction in prices because of interest rates. Now, if you're somebody that believes actually that interest rates will stay the same for the next 3 years, then you should not be investing in multifamily, in real estate, in the stock market. The only thing that you should be investing in, if you think interest rates are going to stay where they are today, is guns, bullets, and food. Those are the three things, because our entire society will not be able to function if interest rates 3 years from now are this high. And if you don't understand what I'm saying, you should start reading articles on how we finance our federal deficit. The United States has a $33 trillion deficit. And if we are paying 2% a year, that's about 660 billion. I think we can live with that. If we're paying 4% a year, that's double of 660 billion. Where does that 660 billion come from? Well, it can only come from the two big places, right? Either defense or entitlements. So we are going to see extraordinary and radical damage to the US economy if these rates stay up like this for the next 3 years. And if you believe that they will come down, maybe 90 basis points this year, 90 basis points in 2024, maybe another 50 basis points after that, not decline to what they were after COVID. Obviously, that was a unique event, but maybe going back to 2019 rates. If you believe that, then today multifamily is cheap, because these cap rates are based on these rates staying where they are. And like many market participants, I believe that we are going to see a decline in rates. Again, once again, not to an outrageous level. I don't think we ever get back to a 30-year single family. Not ever. For a while, maybe for 5 or 10 years, we don't get back to a 30-year single family, loan being under 4%. So I think they're going to be in the fours, maybe even the low fives. That's fine. But for them to be in the fours or the low fives, right? Even the low fives, we still have to drop more than 200 basis points from here, which means we have to drop by more than 2%. And that drop is likely to occur in the next 24 months or maybe 30 months. Well, if that's the case, then you have to understand that today's cap rates are a discount because nobody buys a multifamily property to hold it for a year. You're going to minimum, you're going to hold it for 3 years. You're probably going to hold it for five. So if 3 years or 4 or 5 years from now, interest rates are lower, then aren't you buying today at a discount?
Yeah, I think our 10-year treasury needs to be in the threes in order for the fives to even be in existence for interest rates, is what I was reading up on this morning as well. Um, this is, I think that this is going to be the year, this year, next year, the year of the operator, and the year after that. So what? And I know you're very logistically oriented and data driven in operations. So what are some asset management strategies that can be employed for the operator to manage the assets?
Well, I think the first thing is that you've really, really got to make sure that your balance sheet is strong. Raise money, raise extra money. Tell your investors, right? In boom times, the job of a syndicator is to make as much money for investors as possible, basically maximize returns. In bear times, the job of the syndicator is to protect the investment of the investor. That becomes your primary job. Protect my cash. Now, there's some investors that won't like that. You should be ignoring them because I think the vast majority of your investors are pretty smart, inexperienced people, and they understand what I'm saying. Protect the investment first, then worry about anything else. Well, if you're protecting the investment, you should have a significant amount of operating cash. You as a syndicator were able to raise many millions or tens of millions of dollars when the going was good. Well, why can't you raise a few $1 million of pref equity for this project or the other? Why can't you raise lending? Right? So we've shored up, we have a project in Killeen, we've shored it up with $500,000 in private lending. We have a project in Dalton, Georgia. These are performing projects. There's nothing wrong with them, but we've shored them up. One of them, we decided we're going to take it to a Freddie Mac 5-year fixed rate, and we raised $2.5 million in internal equity, in pref equity, and we're taking that property in coming up here in the next few weeks to a fixed rate loan. Bottom line is, you should be looking at your database right now to raise pref equity, to raise loans for your properties, and be very strongly capitalized. That's the first thing I want to tell you. And then second, it's all about operations, 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 operations.
Yeah.
So
Yeah.
I'll give you, obviously there's a lot of, looking at operations, going into those meetings is a big deal, but captive insurance seems like an interesting thing. So look at a company called POPIC or POPIC. That might be one that gives you some benefits. But in general, there's captive insurance. And I think that's a very interesting, sort of angle to look at.
For the is that to help hedge the insurance costs that hit a lot of
Well, essentially, you become an insurance company yourself in a way, right? So you become the insurance provider to for your properties. So there's also things like renters insurance, things like that. You need to really look at, okay, without raising rents, which obviously will hit me right now, what other fees can I put in the pocket of the project as opposed to some third party?
That's huge. I know. Of course, our underwriting, we're underwriting zero rent increases for the next 3 years. We're just doing whatever we can to break the deal and make it make sense. It just as well as assuming existing debt, I'm still seeing that there's an extraordinary amount of equity that would have to come in to assume the debt. So then you take in cost of capital on investors' equity and then blend that in with the interest rate. And a lot of these deals are still not making sense. But time will tell. And then captive
Well,
insurance.
I think they're not making sense because you're underwriting 0% rent growth for the next 3 years. I think you're wrong. I think that there's no data to suggest that we would have 0% rent growth for the next 3 years. CoStar data, if you look at it on a nationwide basis or looking at any metro, shows positive rent growth. Now that rent growth with CoStar is fairly anemic, meaning 2024 might be under 1%, 2025 might be around 2%, 2026 might be higher than that. So it's fairly anemic, but 0% rent growth in underwritings makes no sense because that's ultra conservatism, which doesn't make sense and doesn't help your investors. That's my belief.
Our data, and I like that. I appreciate that. We have a plateau on our data table showing for the next 24 months of rents going up and then just plateauing, possibly declining. But beyond 3 years, getting out of the shadows, then starting with our 3% increase per year. But it is ultra conservative and going into sort of unknown territories and the just where the markets are at. We're trying to make our deals break, and if they look good and the offers go through to accept it, then we feel like we've got a great basis. But
Yeah.
for sure, it's
Obviously you can be as conservative as you want, right? If your math works, that's great. If your math doesn't work, then you're missing out on the discounts. So it really comes down to making a lot of offers and losing a lot of offers and hopefully winning some.
That's true, 100%. What role does data play in making investment decisions in multifamily with the current economic uncertainties? And I know we've kind of went over this, but you're mad scientist of multifamily, so you're looking at data tables all day. What are some ways that it plays in your decision making?
I think just because I play with data a lot and I look at data a lot doesn't necessarily mean that I'm 100 miles ahead of everybody else. That isn't the case. I think that I tend to learn faster from data than other people because I'm more tied to the concept of letting data guide me. And one of the things that I've learned is that late in the cycle, and this is learning for me, so I'm sharing it with you, use it as you wish. Late in a real estate cycle, you may be better off investing in Midwest cities than in ultra hot markets. So early in the cycle, when we invested in Dallas or we invested in Atlanta or markets like that, we benefited a great deal because the market was going up and it was going up very fast. Tucson, perfect example of those are the places that we invested in, made a lot of money. But late in the cycle, I think it makes sense to start looking at markets that have not become overheated. So today, our data shows us that Midwest markets, which we typically have not been very complimentary on, and I feel some level of regret for that, by the way, are actually the markets that make the most amount of sense today because these are markets that didn't scream upwards. Their rent growth was not as crazy. And so almost all of the markets forecasted for strong rent growth in the United States are Midwest markets. None of them are boomtown markets, with maybe the possible exception of Miami, which is bizarre. Everyone's saying, "Hey, we're not sure why Miami just keeps going and going." But with the exception of that market, a lot of the boomtown markets, whether it be Austin, Nashville, Dallas, Boise, Denver, and then some of the Florida markets that are pretty famous, they're not showing a lot of upcoming rent growth because they've had a ridiculous amount of rent growth and a massive amount of incoming supply. What's data telling me right now? The one thing that every operator needs to look at right now is supply, supply, supply. There's nothing else that we see in the data that is a 800-pound gorilla. And no, it's not interest rates, because we believe, and this is again being recorded in November, the Fed is done. So obviously interest rates were the most important thing for you to look at for the last 20 months. We think the Fed is done. Either the Fed is not going to affect you by keeping rates flat for the next 6 months, 7 months, whatever, X months, or they're going to start dropping them. Either way, the most important thing that you need to look at is, am I buying in a market with huge amounts of incoming supply? And that's why I think you'll find that a lot of Midwest markets make a lot more sense right now.
Very cool. Absolutely agree with you too. On as far as the Sun Belt states where you're investing on those markets, are you saying that there should be a pause, not as aggressive, or just let the markets kind of settle out?
I'm not saying there should be a pause. I think you should be just very careful with your rent projections the ultra hot markets are where there's a massive amount of inventory coming in. So, most people have access to CoStar reports through their brokers. Just look at the incoming inventory over the next 18 months as a percentage of existing stock. If that number as a percentage is between 3 to 5, be cautious. If it's over 5, be ultra cautious. If it's over 10, run like hell.
Absolutely. As far as conversations with brokers and lenders, what what do those conversations sound like as far as submitting deals, or I guess what are we looking for when we're talking to the brokers? Are we putting in offers and then we're being conservative, or are we putting in aggressive offers and seeing if we can get them to the home plate?
Well, I want to share an insight with you that I hope people will remember. There is this feeling in the multifamily syndication community, completely irrational feeling, that when times are booming, right? Let's say early 2022, the gap between buyers and sellers is the highest, right? That gap between what buyers want to pay and what sellers want is bigger. And that gap should somehow shrink now that we are in the down part of the cycle. There's actually no evidence to suggest that this is ever true. The gap remains the same. The only thing that changes is the price. So let's say I think that the right cap rate in 2022 was 4, and the seller thought it was 3.8. So the seller wanted a 3.8 cap rate. I wanted 4. That gap is 0.2 cap, right? Today that gap is still 0.2. It's not any lower. It's still 0.2. But today I think the right price is 5.6 cap, and they think that the right price is 5.4 cap. So people who are waiting for a change in the buyer-seller gap are going to be sorely disappointed, because there's actually no data that I found that actually indicates that it shrinks. Like, for example, in 2009, right? Properties that I now own that are $400,000 in value, I was buying them at $90,000, right? During that time, the buyers wanted 110, right? They wanted 110. I was buying for 90. The gap was 20,000. Today, if I want to sell my property for 400,000, I'm going to want to sell it for 400, and the buyer wants 380, right? So the gap didn't change. The gap is ever present. The buyer-seller gap is not something that you should ever be focusing on. You should be focusing on whether your deal works, right? And that's the basis of it. So I want to ask you, given that net operating incomes have not changed much, Josh, in the last 18 months, right? They've gone up slightly, maybe tiny little bit, because what's happened is rents have gone up slightly over the last 18 months, but then expenses have gone up quickly, including insurance. So that has sort of evened out. So more or less, if you look at 1,000 multifamily properties, their net operating income compared to 18 months ago is more or less the same, maybe slightly higher. So given that net operating incomes are slightly higher, why the hesitation today to say, well, I'm overpaying if I'm at 5.5 cap, I should be at 5.6 cap? Well, weren't we the same people, you and I, that were basically saying, well, 4 is too high, too high. I want to make 4.1, 4.2, right? So, or 4, so the truth is, what has changed is rates, right? There's always going to be a buyer-seller gap. And what I find is that unless you're just unreasonable and overly bullish, there's still going to be a tiny gap between where you think you're going to pay and where you actually will pay. And that doesn't change today either. And you're going to have to reconcile that. And I find that that tiny gap doesn't affect your success or your investor success. What affects it is the actual purchase price. And today that actual purchase price is 25% lower than it was, 18 or 19 months ago.
Yeah, I agree. Your NOI might be flat for the next 12, 24 months, where your CapEx continues to incline or stay the same. So you're compressing your NOI in a fashion, but ultimately coming out in the end, appreciation does kick in, and then interest rates do come down. So forces collide, and then we've got another bull run, at least we think.
I think maybe the word bull run is something that needs to be explained. I think that there's going to be a bull run in 2026, but is it going to be a bull run like 2022 or 2021? The answer is no. That bull run was driven by 0% interest rates in an economy that had $3 trillion poured into it. So it's a very unusual circumstance. But a bull run simply means greater rent growth than 2% or 2.5%, which is, if you look at the 10-year average, it's 2.5%. Well, actually more than 2.5%. And if you look at the 50-year average, it's 2%. So if you're going to see rent growth in the threes, well, that's a bull run because rent growth drives prices, right? And if you see cap rates today at 5.5, and those cap rates go back to, let's say, 4.75, not the crazy 3.75 cap rates that we saw 19 months ago, but to 4.75 to support lower interest rates, then that's a bull run. It is a bull run. It's a normal bull run, just not one like 2021.
We've also got new oncoming supply as well. What is your take on that with the, we've definitely got a spike coming online, which will offset.
Yes, and it started already. So most of the the heavier new supply basically started coming in the second half of 2023, all of 2024, and the first half of 2025. Now when the supply is coming in is actually different metro by metro. So some metros are going to still be delivering late into 2025. Some metros will, like Phoenix, which is like an early delivery metro, almost all of that supply will be gone by the end of 2024. So know your metro, know when the supply is coming in. CoStar and others provide these kinds of data that you might be able to get from your broker. And bottom line is, look at that data and make decisions accordingly. One thing that you should expect, though, is that this excess supply, there's always supply, excess supply is going to start moderating once you get into 2025. And in some metros, by the second half of 2025, it will really aggressively moderate. And by 2026, you're going to see that gaps. You're going to see negative supply, well, no, you'll still see positive supply, but the supply will be a lot less than the demand in 2026. And so that is why 2026 represents our best chance of higher rent growth in the current scenario. So, but I don't expect 2024 to be a good year simply because there's a lot of supply. But keep in mind, there are many metros that are not affected by this supply. For example, Kansas City is 2 million people, it's not affected. Indianapolis is 1.7 million people, it's not affected. Whereas a lot of the Southeast metros are going to be affected. So it's going to be metro by metro, impact. Also, by the way, a lot of people say I'm Class C, so I won't be impacted. That's a very common thing that I hear on podcasts. It's just a bunch of nonsense. So you haven't studied the 2008 impact and its impact on Class C rent growth. I'll just leave it at that. Why don't you spend a little bit of time studying the impact of 2008 as a recession on Class C rent growth, right? Why don't you study when in the past there have been large amounts of supply in certain markets, what it has done to Class C rent growth? The answer is the only thing that can be said fairly is that when a large amount of supply comes in, Class A is impacted the most and the longest. Class B is impacted a little less long by a little less in rent drops. And Class C is impacted the least in terms of rent drops and the timing, but still the impact of Class C is substantial, both in terms of the amount of time that rents are low and the actual drop in rents. That's what data shows, and all three classes are affected.
Yeah, Class A moves down to Class B housing, and Class C props up the economy, workforce housing, and there's job losses all across the board.
There are. So when you have negative household growth during a recession, Class C, guess who they lose people to? They lose people to D or to mom's couch or to people's cars. So there's occupancy in Class C also falls during a recession. And it also falls during a period of very large supply.
Yeah, awesome. Neal, if somebody wants to get a hold of you, learn more about yourself and your Grow Capitus, how can they reach out?
So we all of our data, right? There's massive amounts of our data, and we provide it in many different ways. The best way to look at it is because raw data is not going to do anybody any good. The best place to go is multifamilyu.com. That's multifamily followed by the letter u.com. We have about 20,000 people that sign up for our webinars. So we take the data and we chunk it into a dozen webinars with interesting insights, both for syndicators as well as for investors. That's the best place. There is no paid product. There's no upsell. There's no subscription. We don't intend to sell education. It's just come here, learn. The only thing that we do is whenever we do a webinar, we have a 30-second time frame where we tell you about our latest projects. You can just tune out for those 30 seconds, and nobody will ever call you or bother you with it.
Very cool. Neal, I always enjoy following you. We definitely appreciate the insights, and again, appreciate your time. Thanks for coming on.
Thanks for having me on the show, Josh.
All right, thanks, Neal. Bye.